there's a massive short squeeze in Beyond Meat, which recently IPO'd. But before I talk about this more in depth, let me just talk about the stupid disclaimer. So anything I mention here is for informational and educational purposes only. It is just my opinion. Do your own research and due diligence. This does not constitute financial advice. And please trade and invest carefully, especially with this company. So if you guys remember, in August of 2018, I went through detailed analysis of Tilray Marijuana Corp. It was like one of the darling IPOs. The stock was on fire, and I read through the annual report. I read through the financial statements, and I found a lot of the problems with the company before a lot of other people. And so the stock was on fire, but I said, give it 6 months, maybe 12 months, let things play out, and this company was going to have immense problems because the corporate lawyers made management disclose in the fine print, deep in the credit risk and the other bankruptcy risk of the company, that the company had never been profitable in past history. They might never be profitable, and there were immense problems. And lo and behold, after about 6 months or so, the Tilray share started to crash after that, and I believe Tilray is down more than 90% from around when I talked about it, and insiders in Tilray have been dumping like crazy. And I think potentially 6 months, 12 months from now, we could see a very similar story play out for Beyond Meat, which is symbol BYND, which is Brian, Yarn, Neil, David on the NASDAQ. It IPO'd on May 1st, I believe, of this year. So it has not been trading for very long. However, it looks like it is having a absolutely massive, epic short squeeze. On Friday alone, the shares went up almost $40. And today the shares are up. Let me take a look when we're doing this live stream. The shares are up almost $30 per share, $29.45. They were up earlier 23%. They're only up about 21.24% at $168.10 a share. So just in the last couple weeks, really since June, it looks like June 6th or 7th, the shares have gone up, not parabolic, but logarithmically. So a step function up, and then a sideways a little bit, step function up, sideways a little bit, just been going nuts. And I think that has a lot to do with the short squeeze that is going on, and also I would say inexperienced investors and traders that are shorting this thing way, way, way too early, and I'll talk about that now. So this company is putting out press releases about revenue growth, massive amounts of revenue growth, and the algorithms, the short-term oriented Wall Street traders, they like companies that have momentum. They like companies that are putting out good press releases with revenue growth. However, beneath the surface, there are a lot of problems with this company. And this is why, if you want to be a good investor or even a good trader, not a day trader, if you want to be like a swing trader for long trades that are at least 3 months or 6 months or a year or two to play out, and you want to make big gains either on the long side or the short side, you need to know fundamentals. You need to know how to read financial statements. So beneath the surface, the company's operations are not as good as the PR statements look. So first off, Beyond Meat right now, its market cap is almost $8 billion. Okay, it's $7.96 billion. And the operations, they are growing revenue. I believe they're growing revenue at about $200 million increase in revenue growth. However, when you look at the financial statements of the company, it is a totally different story from operations, from the headlines and the revenue growth. So the operations, I went back and looked, and first of all, the Beyond Meat on their website, they have a link to the SEC filings on there. They don't have easy access to the annual reports. All the main filings that you need are not easy to find. So I don't know if that's intentional or not, or if they're just their investor team, investor relations, is just focused on putting out press releases right now. But the press releases are good, the market's eating it up, and the stock price is rolling higher because there's too many people short the stock who don't understand how IPOs in general work. There are some IPOs that end up quickly below the IPO price, but most of them do not. And that is because of market mechanics. That is because, number one, investment banks in a lot of cases are contractually obligated. There's a lot of contracts and there's financial penalties for propping up the stock, at least for a certain amount of a period. And on top of that, there's the lockup period. if you're not familiar. The lockup period means how soon are the insiders at the company, so the CEO, the board of directors, the senior management team, how soon are they allowed to start massively dumping their shares? How soon are some of the venture capitalists that are still holding the shares post-IPO, how soon are they allowed to start dumping their shares? The large 10% or more shareholders. So with an IPO, you have to know this normally. And if you figure this out when the lockup period expires and when the press releases stop going so positive, that's when the trouble starts. So we're not there yet for Beyond Meat. We're probably at least a couple quarters away. It could be 6 months or a year. You have to see a couple bad quarters of bad news. It might only take one really bad quarter, but let me talk about the operations. And like I said, the SEC filings were not easy to find. There is not an annual report out yet for Beyond Meat where it's listing, and I went through the website. I spent about 2 hours on this, and the website does not have an easy to download annual report where the corporate lawyers are listing all the bankruptcy risk, all the credit risk, and all that. So the company just released their Q1 2019 financials, and keep in mind that this was before the IPO. So before the IPO, before the company raised $200 million, their balance sheet was bad, their financial statements were bad as well. So before the company raised $200 million in cash at IPO, the company had $35 million in cash and $30 million in debt, and they were cash flow negative. So yes, they have nice press releases with revenue growth. However, they're generating negative cash flow, which means they're burning through their cash like crazy to grow their revenue, which means to me, if you study financial statements, and this is how you measure management. You can tell management by looking at the financial statements, by looking through the balance sheet, the income statement, and the statement of cash flows. You can tell how efficient management is. Are they guarding margins? Are they improving margins? Are they letting margins fall? This management team only seems to be able to do gross profit, gross margins. Everything else is a disaster in the operations, from an operational perspective in the financial statements. So in a year alone, from Q1 2018 to Q1 2019, which was before their IPO, this company burned through an extra $20 million approximately in cash to grow revenues, and the losses grew. I'll talk about the burgers and the problems with the burgers a little bit later in the show. I want to focus on the financials. So, I went through some articles with research. I went through Google searching, looking for it because I couldn't find easy access to the financials. And I found a copy and paste, which I'll attach a link to it, of a older Seeking Alpha article, which is behind the pay part now on Seeking Alpha, going through the old financial filings from 2016, 2017, 2018. And it is not very pretty. There are operating losses. Let me pull it up really quick. There are losses, let's see here. Loss from operations in 2016 of almost $25 million, 2017 of almost $29 million, and of 2018 of almost 28. So they did have a gross profit 1 year in 2018. However, there was problems in that year as well, like I said earlier. So they have negative operating cash flow. And that is a big, big red flag. That means management needs to figure out how to either cut costs at the business or grow more efficiently, or come up with better products and services at better margins, or the company will start burning through that cash. And the company has a history of burning through cash, and in order to grow revenues, the losses are not cut. They're either the same or larger. And it's been this way for at least 3 years as far as I can tell. So the company now has $200 million in cash, according to the last financial statement, and we'll see how quickly they burn through that. Okay, it sounds like they're going to be very, very aggressive about growth, but like I said, they're not growing efficiently at all. However, this is not financial advice, just my opinion, stupid disclaimer. This is not a good stock to short right now. Number one, if you go out and borrow the shares from a broker, they're out. Supposedly, a lot of online brokerages are out of shares to borrow, and the puts are very expensive. Also, another mistake that people make besides not researching when the lockup period expires and other things like that is that they don't hedge their shorts. I know a lot of financial professionals, as you guys know, a lot of very smart people in finance, and a lot of these very smart people, they have very bad stories about mistiming shorts. So they might have done the fundamental research right for the balance sheet deteriorating or a macro top-down, bottom-up research for shorting a company, but they totally screw up the timing. The market stays irrational longer than they can hold on to their short and cancel it out. And I ask a lot of these people about their trades and if they hedged their short. So either they bought a few call options, a small amount of them, to hedge borrowing the shares or buying the puts. And almost every single time when someone tells me about a short that they researched and lost a lot of money on, and that eventually the short ended up playing out, but they screwed up the timing and they lost a lot of money in the process, almost every single time these financial professionals tell me that they did not hedge their shorts. So that's not financial advice. It's just a valuable lesson and something to think about, that a lot of these financial professionals, very smart people, do the research, and long-term they may be right about something, but the market irrationally is going higher. And I think this is the case right now with Beyond Meat. So the market is mostly paying attention to the revenue growth, the positive press releases, right? But in 6 months, 12 months, whenever that lockup period expires, the shares are in lockup now. And whenever Beyond Meat starts to really burn through that $200 million in cash, because if you go back and look through the financial statements, you can tell that the management team is not efficient at growing this business. They don't have a history at all of profitability. They have 1 year of gross profit, and that's gross profit. That's not net. So this company will eventually crash. The shares will almost guaranteed eventually crash. It's a question of when, not if. The timing of these things is going to be the toughest to figure it out. It is going to by far be the toughest. This is just hypothetical, not financial advice. If I was trading this thing, I would almost, and this is going to sound crazy, I would almost buy out of the money call options. And because in the short term, this thing's probably going to go higher because shorts are going to panic and cover, and the company is probably going to continue to issue ridiculous press releases. Today, I believe the company issued another press release that they expect revenues to increase $5 million this year, an extra $5 million, right? But you have a $7 billion market cap company with an increase in revenue projected of only $5 million. And then the stock analysts covering this company raised share price targets. Even though the share price targets are below the current price targets, markets reacted to that news. The algorithms and panicked shorts who covered reacted to that news. So I would stay away from shorting this company for now. I would, again, not financial advice, but I would watch the cash balance. You need to see when the insiders really start to massively dump shares, when the lockup period expires, when the chart starts to go negative finally, because it's almost in parabolic mode, and the cash balance. So insiders dumping shares, and then when we get an annual report, I will hopefully be able to take a look and go through and start reading some of the stuff for you guys out there. Because I guarantee, based on the financials I have looked at in operations so far, that there are going to be disclosures in there by the lawyers that they're going to force management to do. The corporate lawyers are going to force management to disclose stuff about their debt, their credit risk, and potential bankruptcy risk of the business. But normally these things are hidden in fine print on like page 10 or page 40 of a 100-page document. So that the average person, even a lot of financial professionals, are not going to do that work. So you have a situation now where a lot of people have shorted this stock, way too soon. Okay, there's too much buzz, too much press releases. Management is growing the revenues, and the press releases, the stock is responding positively to press releases that are revenue only. Meanwhile, like I said, the operations, the financial statements show that operations, the business is very inefficiently run. So this is going to take some time for sentiment to change. You're going to have to see the chart damage first. So you're going to have to see the fundamentals are bad. You're going to have to see them get worse. I would monitor the cash balance. So if you see all of a sudden where in a couple quarters you see that $200 million drop below $100 million, or you see it drop to $60 million or something like that, eventually this company, based on what I'm seeing from management, and I haven't looked at the last 3 years of all the financials thoroughly because they're tough to find, but what I have seen looks bad. And at some point, man, the management team's going to blow through a lot of that cash because of the cash burn, the negative cash flow. They're not cash flow positive. They're not growing efficiently. They're not using free cash flow to grow. They're not even break even. And they're going to have to raise additional shares. And there's additional research that food companies in general, guys, they don't sell for high valuations. Food companies are normally not the best businesses. So this company is trading like an insane growth stock, but the industry that food companies are normally in does not sell at premium valuations. Normally those companies sell at very low multiples. So those things will eventually change. I expect that too. This company, a couple years from now, it could end up getting bought for way, way cheaper. There's no way that this company should have an $8 billion market cap right now. It doesn't have really good operations at all. It's just revenue growth. It should, with the $200 million in cash, it should have at most $1 billion market cap, probably even lower. But because of the market we're in with revenue growth and all these stupid algorithms and then people shorted the stock way too early, you have the short squeeze plus the momentum growth with the revenue growth and the algorithms. So let me talk about the actual the meat in quotes. So this is vegan, but this is not, its labeling sounds way better than it actually is. 1 second. Okay, so there's an article on the scienceofeating.com, and this is like organic and grass-fed beef and bison meat. So they talk about healthier ways to eat. And they talk about how a lot of these burgers have massive amounts of salt. They talk about all the ingredients in there. So this is plant-based meat. However, a lot of the plants are heavily processed in there. So they lay out the argument in here how supporting your local farmers' grass-fed meat is sustainable. And there's a relationship between land and animals. They need each other to thrive. Animals feed the land. They nourish it. And a lot of the input into this beyond, not impossible, but impossible is another one. I think that's Bill Gates' one, right? So a lot of the inputs into this Beyond Burger, this vegan meat in quotes, is soy. Also pea protein. And there is a ton of salt. And I have another article up that I think 63% of the complete calories are derived from excess fat. So this is not super healthy either. The cost of these is also higher, a lot higher than true ground beef. So the consumer's thinking that they're helping the environment, they're paying more money for something a lot more nutritious, and the reality of the situation is that they're getting something with a lot of salt, a lot of fat, and a lot of processed plants. A ton of soy in there. Yes, this is way worse than grass-fed beef. I will attach, if you want to go in depth on this and look at the ingredients, ingredient by ingredient, I have articles on that. This is a fake health food. This is a fake health food. This is fancy marketing, fancy packaging with revenue growth only press releases. So eventually there may be a market for this eventually, and a large food company may buy this brand eventually, but this stock is probably, after it's done going up in 6 to 12 months, this thing's going to crash like 90%. That's just my opinion. Not financial advice. At some point, this thing, because management has showed that they do not know how to efficiently grow the business. So I will be proven wrong if management can figure out, and they have at least a 3-year track record from looking at their financials of not being able to efficiently grow their business. Revenue growth only, and even most of those years, they have losses in gross profits. So their gross margins aren't even that good. I have never, Tang asks, has anyone eaten their meat? Some people actually like it. So supposedly some people say it's actually tasty, but that's because there sounds like there's a lot of salt and fat in it. So if you've read the book Sugar, Salt, Fat, there's food chemists that can use a combination of those 3 ingredients to make almost anything taste good. And it sounds like this is the case with the Beyond Meat. That it's a combination of salt and fat. Massive amounts of it. So yes, it's using plants, but it's also heavily processed, and a lot of the stuff a lot of the plants that's going in there is not healthy stuff. Another agenda company like Tesla. Yeah, it basically sounds like that. But at least Tesla had a cool product that a lot of people liked. A lot of people did like the cars, although now the cars are breaking down. There's more evidence of that. We see the massive amounts of inventory of Teslas in the lots. And we see lots of cars, Tesla cars, that weren't properly tested in the Canadian winter or other places where the bumper's falling off and other problems. Briggs says narrow profits. That's not what I saw in the release. Their Q1 earnings release, I can pull it up again. Let me see here, the SEC filing. Yeah, they were burning through a lot of cash before their IPO. This management team is not, maybe the management team is good at making products or services and good at revenue growth, but this management team has not proven to me at all that they can efficiently grow the business. And this is how you find that out, by looking at the financial statements and the stuff in the operations, by the margins, and then looking at the statement of cash flows and the income statement. Oh my God, D's nuts. I cannot say that on, on a podcast. So the company has beat guidance. They are growing revenue fast, but it's a non-GAAP loss. And there's red flags also. They're doing adjusted losses. It's non-GAAP loss. So the real losses, the non-adjusted losses, are even larger. So the company is issuing financial statements now in adjusted earnings per share and non-GAAP. So another red flag. So I will attach links if you want to look at this more in depth. I don't really have a lot of extra things to talk about now. If I had an access to the annual report, I would read more from the credit risk and the bankruptcy risk section. But in probably, I would say at most 12 months from now, it's going to be a totally different story. I could see shares IPO'd at, I think, at $25. About 12 to 18 months from now, if the company's not bankrupt, I think you're going to see the shares below the IPO price. But getting from there to now, I could see the stock in the short term go up a lot more. But the two main things, like I said, to sum this all up before I let you guys go on the short show, the two main things to look for are how quickly is the company burning cash. And so they just raised $200 million at the IPO. If they had not raised that $200 million, they would be in big, big trouble. They are burning through cash way too quickly. So this looks to me like something that the venture capitalists dumped on the public markets because they saw the operational red flags in the financial statements and how inefficient management was, like I talked about. And they figured if we can get them $200 million in cash, we can make the share price go a lot higher before management burns through the cash, and we can issue press releases with the revenue growth. So this thing's going to take some time to play out. I would not be, again, not financial advice, just my opinion, I would not be short the stock right now. I would wait. So you want to see the cash, which is $200 million, As of now, you want to see that cash burn. You want to see that cash get down a lot. You want to see maybe management issue more shares, more equity dilution, start to take on more debt. Okay, you want to see those types of things. And then finally the lockup period expiring. So and again, if maybe you have to email the investor relations department of the company and ask them when the lockup period is expiring for the shares. When senior management, the CEO, and the board of directors are allowed to start dumping massive amounts of their shares. So once those things happen, either one or a combination of those things happen, then you'll really start to see the stock totally crater. But until you see those things happen, the stock may go up a lot higher, especially when people are shorting it too soon, and then people panic and start to cover. Because short covering creates a short squeeze, and that rockets the stock higher. And that's what we have now. We have a situation where not only is the management team issuing press releases that show revenue growth, and that's exciting the short-term momentum traders and the algorithms, the high-frequency trading algorithms, but also you have the short squeeze, where the shorts who were shorting this thing as soon as it IPO'd, way too soon, considering they had $200 million in cash. Way too soon they were shorting this. That they're covering now. Some of these guys are covering. So I want to thank Eric for the $4.99 super chat donations. Very much appreciated. I'm not sure. There are some good Seeking Alpha articles coming out on this. So if you want to pay more attention to this, take a look. But I talked about some of the main mistakes that some of these financial professionals I know do short. So to wrap things up with the main mistakes that financial professionals make shorting is that number one, they don't hedge their shorts. So they do the research and they make a bet on either borrowing the shares or buying puts, like out of the money puts. But they don't hedge their short position. So if they buy in the money puts, they don't hedge any of their short position at all with calls. Even buying like 10% of a total stock position with some calls would potentially protect you if the stock price goes up against you for the short term. Okay, you could, if let's say, this is hypothetical, not financial advice, if Beyond Meat goes to $250, right, and you have calls to protect your shorts, you could sell your calls then for a profit. And then you could use the profits from that trade to put more shorts back on again later. Or rehedge with a long straddle, with puts and calls. So that's a common mistake. The other mistake is that people complain, I always hear this all the time, from financial professionals too, that, oh, the options are too expensive. Oh, there's too much premium. And then you know what? It's a highly volatile stock, up or down, up and or down. And then the stock moves 100 points up or 100 points down. And then you still have these financial professionals complaining to me on Twitter, sending me emails that the premiums were too high and that's why they didn't want to buy the options. But the stock moved 100 points. So if you're paying like $600 or something like that for an options contract and the stock goes up 100 points, you still probably made money. Okay, again, not financial advice, just hypothetically. So there's very common, even financial professionals make these mistakes, guys. So for every Jim Chanos or the guy from Bronte Capital, there's a lot of financial professionals that are very smart people that totally screw up on shorts. So I don't want you guys to make those same mistakes, and I talked about some of the problems here, and this is going to be a story that we'll see play out probably in the next 6 to 12 months. I would be based on the growth plans that management has, I would be pretty surprised if their cash position isn't drastically drawn down from $200 million, especially if they have negative operating cash flow in the next 12 months. So then management team is going to decide, are we going to slow down our growth? Are we going to cut costs? Are we going to sell more shares and dilute? Or are we going to take on debt? Or are we going to do a combination of these things? And from what I'm seeing in the financial statements from the past, before the IPO, and their newest one that they issued for Q1 of 2019, before the IPO, it's looking like that's exactly what's going to happen over the next 12 to 18 months, barring a major turnaround in how management runs the business. Okay, guys, well, I think I covered this enough for right now. And I have read a ton of books about business and value investing. So I do know, besides gold and silver, a lot more about business, investing, finance, economics. A lot of people think I only know about mining stocks. I actually started off as a value investor first, and my day job was fundamental analysis and value investing for a company covering regular stocks, or actually stocks in a bunch of different industries. I also covered oil stocks too. They made me work a number of different jobs there, and they grossly underpaid me and then threatened me to fire me all the time. Okay, well, that's it for right now. Everyone have a nice rest of your week, and I will be probably back later in the week. I may have a couple interview guests. I'm working on some stuff. You guys mentioned some requests for some guests. I'm sending out emails now. Okay, bye.